Here with Randy Schwimmer. He is the Senior Managing Director and Co-Head of Senior Lending at Churchill Asset Management. So to kick things off, in today's world of economic uncertainty and recession fears, what's your general outlook for U.S. private debt as an asset class in 2023?
Well, if you think back, Clark, to the recession and its aftermath, one of the conclusions that investors came up with was, how can I prevent deterioration in my investments caused by volatility, number one, and how do I protect myself against bad loans that are created by excess trading at a time when you don't necessarily need to trade because you're going to lose money. And what happened over that decade after the Great Recession is that a number of investors started to look at the world of asset management and realized that the advantage of private debt was that it was illiquid, so that in a difficult market where prices were going up and down, the values of these loans did not change much. And the other thing they realized was that the yields that were being provided by private capital over a period of time were in excess of public options. And that so-called illiquidity premium, which investors demand, since we can't trade, we're going to need a little bit more yield in order to make up for that. And but over the decade from 2010 to 2022, interest rates, as you recall, were near zero. And so what happened was the differential between public credit, high yield bonds, broadly syndicated loans, and even corporate investment grade investments, those were trading at such low numbers, 2, 3, 4%, that the 6, 7% unlevered yields that private credit was trading at was actually really helpful. And so for that decade, we saw a lot of appetite for the asset class, both because of the stability of spreads, as I mentioned, in yields, and also because of that differential. And so that really generated most of the interest. And then things changed in March of 22 when the Fed started raising rates.
Right. So how has disruption in the public credit markets affected the U.S. private capital industry?
Whenever you have volatility in the public markets, it makes the prices of public credits more challenging, which for a bank that's trying to arrange a financing in the midst of all this price volatility makes it hard for them to set a price for which a new deal could actually clear the market. And in the midst of all that volatility, the direct lenders, private credit providers such as Churchill, were being approached in increasing numbers by private equity sponsors who were doing these deals saying, hey, the public markets are not an option for us. We would like you to help us to finance our deals. And that, once interest rates started to increase in earnest in 2022, became a flood of issuance going to the private markets. And so while we had tremendous success in the prior 7 years before interest rates started to go up on our Nuveen platform, we found that even after COVID and then in 21 and 22, the amount of deal flow that we had increased almost exponentially.
Now, what's the future of the asset class? What changes do you expect to see in the private debt market over the next 5 years?
So if you think about the behavior of liquid assets in 2022, it was not a happy story for anyone who was investing in public assets pretty much of any kind. Anything that traded, whether it was equity related or debt related, traded down, except for alternatives. And private debt was in that. Private equity was also part of that. And so we think that in the current environment, which is the Fed fighting inflation, that environment is probably going to continue for 2 to 3 years. So while they may win ultimately, we expect that they're going to win by increasing rates and by this quantitative tightening. It's going to take a couple of years, and we don't think rates are going to be coming back down to zero anytime soon. Expectations based on surveys from institutional investors of Nuveen have indicated that they expect that higher rates are going to be with us for a while. So if that's the case, and if volatility is going to be with us for a while, and therefore the lack of clarity in the public markets is going to be with us for a while, that means that the opportunity for issuers to access the private credit market is going to be strong, and therefore investors should be able to expect a healthy source of deal flow over the next at least 2 or 3 years. And the advantage right now, Clark, is that because of concerns about higher interest rates and the fact that interest expenses have doubled over the last year, the balance sheets of these new issuers have become more conservative, less leverage, more cash equity going into new deals. That's a positive for investors. So think about it, higher yields, lower leverage, better structures, and in our business, which is really dedicated to middle market companies, all those loans have financial covenants, unlike the large cap market. So we think this is probably the best opportunity in private credit that we've seen in a generation.
So why is private debt worth the illiquidity premium, and how is investor appetite evolving?
Well, the irony is that illiquidity premium is probably a misnomer because, as I've said, the idea of an illiquid asset is actually attractive in a market where prices have become so volatile for the liquid markets. So we knew in 2022 that anything that could trade down did trade down, which meant that, frankly, there was nowhere to hide. The place to hide was really in alternatives and in private debt. And since in private debt, even though it's illiquid, you can't trade it, it was a safe harbor for investors who were looking for stability of valuations. And so to be able to tell these investors, we're going to give you stability and we're going to give you a premium to the liquid markets is hard to beat. And the old idea that simply being illiquid would be punitive and therefore you'd have to pay more, I think eventually people are going to get over that and realize that you probably don't necessarily have to have such a premium over liquid assets. But as long as they do, we're going to pass that benefit on to our clients.
So final question, what do you see as the key drivers of success for private debt managers today?
Well, being large and diversified is always a good idea, and Churchill has grown so significantly over the last 8 years. We started managing a $300 million SMA for TIA Nuveen. Today, we manage a total of about $46 billion across about 40 different funds. As I mentioned, we have the ability to hold up to $500 million per deal. That puts us in a high tier category of direct lenders who can go out to their private equity clients and offer solutions up and down the capital structure. So besides our senior debt platform that I'm co-head of, we also have a junior capital and private equity piece of our business, which allows us to offer solutions in terms of private equity investments and junior capital investments, in addition to actually investing in their funds. And we can take the same sort of up and down the capital structure solution offerings to our issuers and offer the same kinds of solutions to our investors so they can get different yields for different risk and reward strategies. And so we think for the better managers over the long run, that's probably the thing that's going to distinguish people the most.
Randy, thanks so much for your insights.
Clark, it's great to be with you. Thank you.
Thanks. And thank you all for watching.